Joining us now is Lard Friese, who is the CEO of Aegon. Thank you so much for joining us again, Lard. Let me get into the numbers because it's an interesting business as we talk about higher income fees coming through from better equity markets offset by COVID claims. How much of this is going to change in 2022? Because we've already had very bumpy equity markets and it feels as though those claims should start to abate at some point in the States. So just walk us through what you've had and what your expectations are now for the year ahead.
We had a solid quarter in spite of COVID claims that indeed, as a result of the pandemic, have impacted the results. But it was a solid quarter, closing out a strong year for Aegon, both in a net result, which we doubled in the fourth quarter to 1.7 billion for the total year, but also 1.9 billion in total for the operating result for the year. And the solvency positions of the companies are in a strong position. The balance sheet is strong. The free cash flow that we were able to generate due to both supportive markets, but also a lot of progress we made on the operating side, is allowing us to propose a 9 cents final dividend per share to the shareholders meeting, bringing the total dividend per share for the entire year to 17% per share. So overall, I think it's a very solid year that we are able to make a lot of progress on the transformation of Aegon.
Can we talk about investor sentiment from here? Because we've had extremely lumpy markets. There were some reports that retail investors were getting a little bit more interested as they saw some of the lower levels on tech stocks. They're getting back into the market. And by the company's own admission, low interest rates have prompted people to invest in recent years. As we see that changing now with, of course, the BOE with 2 hikes, the Fed primed to move, and even talk over at the ECB that maybe there could be a move this year or some chatter about that in markets. What are your expectations about whether that sentiment will change from investors, whether they'll flip back to just putting money into deposit accounts versus investing money into markets and into funds?
Well, last year we saw a very positive market backdrop, and the beginning of this year with a lot of volatility that we saw as a result from a discovery in the market about inflation levels and what the various central banks' reactions to that would be. That, of course, is a good reminder that these are still markets that are quite choppy indeed and quite volatile. And we will see, is my expectation, this burst of volatility, happening now and then. When it comes to inflation, to the extent that it's followed by interest rates, increasing interest rates, that's good for our business. It makes our products more attractive. It makes the options and the guarantees on our balance sheets way less. And as a result, that's a positive backdrop for us. When it comes to inflation, where it pertains to expenses, of course, that's a headwind for us. But then again, I'm a Dutch man, and I've been taught by my mother that if the winds are blowing on the dikes, you need to pedal your bike a bit faster. So on the expense reduction side, we are confident that we can continue the good progress that we're making in spite of the inflation headwinds that could bring. But again, to the extent that inflation is followed by interest rate increases, that's positive to our business.
Great analogy. Does Madame Lagarde need to pedal her bike faster? As I mentioned with Lars Kramer just now, we have 7.6% inflation rate in the Netherlands. And your de facto central bank has a deposit facility at negative 0.5. Is that appropriate for the Netherlands and for the Eurozone as a whole?
All central banks are navigating through many dilemmas that they have to consider about economic growth and making sure that it's well supported, but at the same time, of course, taking into account the inflation and providing price stability. It's not for me I'm not in the boardrooms of those banks, so it's not for me to comment on that. What is important to Aegon is that in all circumstances that we have scenarios in place so that we can manage the balance sheet in such a way that it keeps the money that the customers are entrusting to us safe. And that's our prime objective, and we've demonstrated throughout the years we're able to do so. And therefore, we cater for a number of scenarios to ensure that clients can look at Aegon as a beacon of let's say reliability and trust in a sometimes volatile world.
A couple of quick questions from me, Lard, and good to see you this morning. Can you tell us a bit more about the reinsurance agreement that you've set in place now in the United States and to what extent that does reduce the risk of volatile exposure to mortality from COVID now in the United States? And my second question would be, could you also tell us a little bit about how you intend to increase fee income through maybe premium inflation over the rest of this year, given that you've obviously had a spike in claims?
Yes, Jeff. We use reinsurance very actively for two reasons. First of all, of course, to offload risk that we believe we would not like to carry ourselves, but reinsurers can carry that risk through cycles better than we do. And if that is at an appropriate cost of capital, that is something that we'd like to do. Secondly, we want to stem volatility in our results to make the results of Aegon as boring and predictable as we can make them. And thirdly, what we aim to do is use reinsurance to free up capital at attractive terms. We have done a couple of reinsurance transactions. The one that you mentioned in the United States, that's really in place to reduce volatility of mortality claims. It is something that we've had in Q3, and we said we would take action. That's part of that. But we also concluded in the Netherlands a large longevity transaction, and that was meant to free up capital. So we actively use reinsurance as an instrument to make our earnings and our cash flow streams more predictable, less volatile, and free up capital in those areas where we can do that. When it comes to premium rates and income, we have programs in place in a number of areas. First of all, in the long-term care business in the United States, we have successfully received approvals from many states and many regulators to increase rates where necessary. And we are doing that in accordance with the policy terms that we have with our customers, and we are making good progress to implement those. What we also see is that let's say the shift that we've made over the years to more fee business is allowing us as well to maintain a good fee-based income streams at relatively lower capital intensity of the product designs that we have in place, which increases over time the return on the capital that we invest and the quality of our earnings.
Well, best of luck going forward, and thanks for joining us once again. It's been good catching up. Lard Friese joining us from Aegon.